We turn our focus now to investing in master limited partnerships, MLPs. SteelPath is an investment manager of energy MLPs, specializing in U.S. infrastructure plays. The firm has $2.1 billion in assets under management, and Brian Watson is director of research at SteelPath, as well as a member of its investment committee. He joins us now from our Dallas newsroom. Good afternoon, Brian.
Good afternoon.
So let's go over first over what master limited partnerships these MLPs are exactly. Can you describe them for us?
Sure, yeah. A master limited partnership just describes the form of organization they've chosen. So essentially, if you're in the business of producing, processing, transporting depletable natural resources, you can choose to organize as a partnership and yet list your ticker on the NYSE or other public exchanges. So it really just describes that form of organization. It so happens over the past decade that it has become the primary form of organization used by energy infrastructure companies, so pipelines, terminals, storage operators.
Why is that?
You know, it really has to go through the history of the sector, obviously being limited to those who are involved in the transportation, production of natural resources, limits who can use the structure. And then from there, really, the first pipelines began to be dropped into MLPs a decade or more ago. They were constructed by a consortium of large producers who got no credit for owning those pipelines or building those pipelines, and so they would use the structure to give themselves some liquidity. And once that process started, it became the home of new MLPs, new infrastructure-focused MLPs.
Brian, how
so
closely...
really,
I'm sorry, go ahead.
Oh, no, I was just going to say, we're attracted to the MLP sector, not necessarily because of the structure, but because it's the house of these pure play energy infrastructure companies.
Right. How closely then are you paying attention to the headlines that are swirling out there, such as the oil pipeline that Congress has been squabbling over?
Yeah, you know, it makes little sense to us why that pipeline would receive such opposition. The truth is that's provided an opportunity for a handful of other midstream providers to help take care of the logistics needed to move crude oil from the mid-continent and further north down to the Gulf Coast. So it makes little sense to us, but midstream operators are working to fill that gap. I think eventually it has to get approved. It's a critical link.
Does it benefit any of your top 10 holdings? I know that you have Enterprise Product Partners LP, O'Neill Partners LP as some of your top holdings in your fund.
Yeah, you know, Enterprise, along with Enbridge, recently announced a purchase and reversal of a crude oil line that will help alleviate congestion of crude production in Cushing, Oklahoma. Whether that would have gone through as quickly with or without the delay of XL is hard to judge, but at this point there's at least a handful of companies taking advantage of the regulatory slowdown of that pipeline.
How about the move in commodity prices overall, such as oil? Does that affect the performance of your fund and these MLPs?
You know, our focus is to buy the names who are agnostic to the price of crude oil, so we want to buy those names who are earning a fee for moving volume or storing volume, or even earning a capacity reservation charge for having that capacity available, whether it's used or not. So our goal in our portfolios is to focus on those businesses that have cash cow, low risk attributes, but by adding to the businesses are providing attractive growth. So we're kind of purposely trying to avoid commodity price exposure.
Right, but sometimes it's impossible to avoid, given that so many headwinds are out there and macro issues move everything right now. The fund launched in March of 2010. How has this shifting macro environment, whether it's the European debt crisis or a super accommodating monetary policy by the Fed, helped or hurt your fund?
You know, the MLPs trade on public exchanges. They have correlations with the broader market. Over time, they're fairly low, but in short periods of volatility, they'll have higher correlations to the broader market. So certainly anything that roils the broader markets will have a spillover effect to the trading of the units. The fundamentals of the businesses themselves have little correlation to those pressures, however. So fundamentals remain intact and attractive despite what we see in Europe. Certainly the biggest macro theme for the sector over the last year has been the rise in production expectations out of the oil shale plays. That new production needs a tremendous amount of midstream infrastructure to handle and to provide those logistics, and it's proving to be quite a boom for those midstream providers, or those energy infrastructure providers, which are MLPs.
What are the biggest risks then for the MLPs?
On a trading perspective, obviously broader market volatility, we expect to add volatility to our stocks as well. A sharp spike in interest rates will always be a risk to the sector. It has an attractive yield and will trade as a yielding security. Over time, interest rates tend to be offset by above average distribution growth. So today we expect the group to provide 5 to 7% distribution growth over the next handful of years, which is pretty attractive. We think that'll help offset kind of a slow increase to interest rates. Mm-hmm. But those are typically your trading headwinds, would be just the broader market interest rates. Fundamentally, again, we're trying to buy names that don't have much exposure to commodity pricing, so
right.
Hopefully we're agnostic to that.
Right, right.
Any major change in the way pipelines are regulated would have an impact, but
of course.
We don't anticipate anything like that.
All right, thank you so much. Brian Watson, Director of Research at SteelPath, a member of its investment committee, joining us from Dallas.